Okay, so following on from the first session, we covered the basics of market structure, right? And so just understanding that when we're on the trend, we're expecting that either the 15-minute or the 4-hour to break. If it's on the 4-hour, that continuation of the break until such time that it doesn't, and then we're creating our kind of swing points effectively from the highs and the lows. What I'm going to do now is obviously go through an actual chart, right, and put all of this kind of theory, which was nice and straightforward, into a much more complex and harder scenario, which is effectively the candles, right? And now the way in which we do this, which makes it a lot more mechanical and I guess less discretionary, the easier it is for your emotions, in my opinion. And it just creates that framework that allows you to be really dogmatic with your approach. There's always an answer, right? I think the biggest thing in trading that I find is when there's ambiguity, or it's not black and white, let's just say, and it becomes challenging to figure out where you are. And so I go by 4 clear rules, right? Not everyone follows these rules. Some people will have slightly different rules, but for me, this always helps me, right? So rule number 1, whenever we're thinking about market structure, the way I like to do is I like to include wicks for market structure. Now, what a lot of people will do is they will say, well, a wick could just be a liquidity grab. And whilst that's true, eventually that wick, even if it's the initial punch through that gets rejected, you start to see, okay, well, if a wick hits a market structure and breaks through to create a new high, you're not going to consider that as a market structure, or you're not going to consider that as a new high point. What it may mean is that effectively when that initial liquidity spike or that push to the upside comes into play, it's just like the first tap, right? The first test of that zone. Effectively what you'll see is it will come back again and eventually it will break through. And so I always like to consider that. The other reason I like to consider that as well, and we'll go into this in a bit more detail, is there's more opportunities when you look at the way the market structure is laid out, the way I kind of put it forward in my thesis, is you see a lot more opportunities for the range pullback. We talked about the pullback before into that discount range, or that 30 to 70%. And so I think the way I kind of map out and a lot of my back testing, what it's kind of give me is a lot more confidence in where them zones are. And so that's effectively why I include wicks, and we'll cover this again, but you'll see this in play. So rule 2, a trend change signifies the reversal. Okay, and again, that goes back to that initial concept where you keep trading the trend until such time that the strong high or the strong low, whatever it would be, breaks. And the moment that strong high or low breaks, well, you consider that as a change of trend, and then you flip the strong and weak the opposite way around, right? And so that's rule 2. Rule 3, again, we should trade with the expectancy of the strength in the trade to hold. Again, that's that strong or weak bias, and only change bias once market breaks with the trend change. However, liquidity sweeps will always be possible, and so you may still find that in some people's theories, it's candles got to close below in order for you to get that break. But because I include the wick, I kind of would, rather than it be a liquidity grab with a continuation of an upward trend, that I would change the trend effectively. So again, I know this is kind of just a bit wishy-washy right now, but it'll all make sense when we go through the trade, the actual market structure trading. And then rule 4, the move that breaks the structure becomes the new structure. So again, you'll see again, we can't apply new swing points or highs and lows, whether it's weak or strong, until that structure breaks. And so they're the 4 rules. And so what we're going to do now, we're on the 4-hour. I've got the key there. Again, we covered that on the first session. We're just going to pick points in the chart, and then we're gonna go ahead. We'll probably just pick somewhere after this initial spike here, just to keep it nice and simple. When we get down to this section here, we're going to dive into the 15-minute, but just from about here down to here, we'll go to the 4-hour. Should be enough to give you enough inclination of what we're trying to achieve. So let's get at it right. Let me just make the screen a little bit bigger. Okay, so just remember the rules, become straightforward. Let's start off here, right? And so we've had this move down to this downside, so let's just signify. Now remember the key. My key is that kind of really light green is the 4-hour highs, and the really dark red is the 4-hour lows, right? So we've hit this point and then we're breaking down, right? So I'm just going to put my first dot here, right, signifying a bearish move. And what we're looking for is a break, right? And so if you think about it, this low came into here. This was that first low, but the magnitude is already on. So what we're looking for is, when does this break to the downside? Remember, wicks count the way I do my market structure. So this one comes down here. This liquidity gets taken by this candle here. Again, we're going to cover liquidity in a subsequent video. But there's the first break, right? And the first break occurs down to that wick there. So what do I call that? That is a 4-hour breakdown. Okay. Now, the way I do this is I want to pick my point. So this is the low point, okay? Because this is the point that we came down to. So I put the dot there. What a lot of people do is look for the highest point. Now, subsequently, the highest point between here and here was actually there. However, it's also the same point that I would use for how I create my kind of highs and lows of the range, right? So the current range, if you imagine none of these candles were ahead here, the 4-hour range would be this, right? It would be that point there, and it would be that point there, and that would be your traded range. But of course, when we break down here, we retrace back maybe 50%. I'll just check on that actually. Just shy of 50%, right? But we do see some retracement. And then, of course, what we always need to do is what's the most up-to-date current trades range, because that's the range that we're trading, right? So if you imagine that's the high, this was the low. Then what happens is we need to signify, well, what was the candle, or what was the range of candles that created the break of this? Well, actually, it was this one, wasn't it? Because this was the candle break. I'm just going to zoom into here. This candle effectively was the break of the low. So that's why we draw that 4-hour low there. But what was the move that created this initial break? Well, it was this candle, right? And so that becomes our point there. So now we can bring our range. So you're always going to bring your range down to that point, okay? And so this now becomes our new low. Now I could theoretically just draw my range, but because I've got candles in front of me, I know that the break occurs there, right? So effectively, that is going to be my new low, right? So again, I'm just going to create that as a 4-hour low. Now, what was the formation of candles that created that low? Well, it was this 4-hour candle in and itself, right? And so, of course, we have a new low there, and then a high. So lower high, lower low, lower high, lower low, lower high, and of course now we have that lower low. So that one candle effectively created the range, okay? And so then what we do is we bring our new range down there, and then we have our new range for the low side down there. So then what happens? Nothing, right? We are just in a traded range. The only time we're effectively changing these lines is when either of these areas break. And so you can clearly see from a market structure perspective, as we're moving down here, that we're making lower highs and lower lows, right? So that's clear, easy market structure, and you can see it depicted by the fact that each time we break, we're breaking the previous low, right? And so the next low we break is here, but you can clearly see that that was a pretty significant range before we broke it. That was like 2 or 3 days we stayed in that range. And so the range will always change, of course, depending upon price action, right? And so we have a new 4-hour low again, right? And so now it's, what was the candle, or what was the formation that created this low? And this one isn't as clear, but price moves up and starts to move down, then up and down, and then up and then down. So I would say it was this one here, right? Or maybe that one. It's debatable, to be completely honest. You could probably argue that that was the candle here that created this move to the downside. And so I'll go with this one. And a lot of this will be subjectivity, even down to the level of how mechanical you can get it, but that's now something we're going to go with. And so what do we see now? Of course, this is our lower high. This is our lower low. But then we get a break to the upside, right? Which we call 4-hour high. And so we break up. Our new range is down at the top of here. Okay, and that would be green. And then we just draw that line there. And we have our, we have to say, okay, well, what was the low that made that high? Well, it was here, wasn't it? That was the low that made the high. Because if you look, no liquidity was taken. We just carried on up, and then we just moved to the upside, right? So nice and easy one. Then we just draw that there. Come back to that in a second. So we make one move to the upside, of course signified by that green dot there, and then of course we just start to break down, right? So here we get our 4-hour low again, even though we got a high that was just one, what do you call it, liquidity punch through and come back down or not. We still got a slight change of momentum there for that short period of time. But you can clearly see, by the way, you know, when we're trading these ranges, specifically when we dive into the 15 minutes, there's a lot of opportunities here. I can just tell on the 4-hour that there's a lot of opportunities when we scale into that 15-minute time frame, and so we'll cover that. Okay, so where are we now? So we've created this low, and so the question is, what was the move what created this low? Well, it was here, right? This high point created this low, and so we move that there, and so this then becomes red. Back to our highlighter tool, go there, change that to red. Okay, so then we've got the high, we've got the low here that breaks through. But now if you think about it, so this range here, I'm gonna just put that really wide for a second. I have to figure out where the range low is. So we come all the way down here, and what we're looking for is, do we take liquidity? So no. What you're looking for is, does the candle pierce above the previous candle? This is just a small range, right? So I'm not considering this. I'm talking about once we really start to move down, you can see no candle pierces the candle above. We get that really deep range wick, right? And so that is where I would put my candle low. And look at that for the 4-hour range. It's quite a significant 4-hour, right? And so where what you found is you've got these quite constricted ranges where we got this one little peak to the upside, but it's relatively pretty much been bearish. And so this is our current 4-hour traded range, right? Bring that there and bring that there. And now it's like, okay, well, now that I've got my 4-hour range, you know, what's the first thing that happens? So we would call this what would we call it? I'll just maybe leave it in red and call that strong high, right? Because we're bearish, we expect the highs to hold, we expect the low to break. Strong high, weak low. And what compounds this even more is just, if you think about it, right, this is why it's important, and we're gonna cover multi-time frame analysis in an upcoming video, but if you think logically, what are we always saying? So always trade strength, never weakness, right? But eventually these things do always break. So you can see, higher high, higher low, higher high, higher low, higher high. So that on a macro scale, right, that's effectively breaking through. If this was a daily range, right, we're trading the 4 hour, but if this was a daily range, you'd see this even clearer. Of course, another high there. Then what did we do? On a macro scale, we created a bearish 4 hour move down, right? So there's some significance to that, right? Remember, my rules are wicks count as market structure breaks, okay? So that's not, I just thought I'd kind of take a quick moment to just piece this in. But so off that basis, this is a weak low for me, right? Because number one, we're bearish anyway, and so whenever we're bearish, the low becomes the weak, and the high becomes the strong, which you don't anticipate to break. And we've also had a break here of this kind of low, and so I always say once you get a liquidity punch, well, the question is, if this low was so strong, why did it break the liquidity? Okay, it's a liquidity grab. Okay, well, it's soaked up that liquidity, right? So all of the liquidity that was resting here for this huge move to the upside is now broke. And so that liquidity no longer resides there. Okay, they've probably got liquidity under here because that was the move that pushed it to the upside. But still, that move to the upside there is bigger than that move to the upside. So there's more liquidity here that pushed that price up to here than what there was that pushed that price from there to there. And so you understand what I'm trying to say? Even though it's a wick, it still weakens that original liquidity that would have been there. And so sort of they punch through it. The question is, you always got to remember with liquidity, it's always about max pain and trying to get as much out of the range as possible before it eventually breaks down, right? And if you look, this move here as an example, we came at least maybe in 70% of the range of that move, and so it's a fairly decent move back in. But when we talk about supply and demand, you'll see that there's a lovely supply zone right here. And so I just think the way markets move, they generate lots of liquidity with all of this moving to the upside and downside, and eventually, it will break. And my thesis is that, and the way I trade is that I'm always going to trade for the weak than the strong. Okay, so and so look, once we've created the 4 hour range, and we know obviously we've been bearish, we had that little move to the upside, and we broke down bearish here with that huge range. And of course the thing that broke that was this high, and then we come down here. Okay, but because we don't break liquidity to the upside, again, this isn't just not classed as a break until we see that liquidity move to the upside. You could argue here we got that little small liquidity break there, but it's just not significant enough because there's nothing behind that. Everything is all above it, even at that point. And so this is just what we call one huge impulsive move, right? That just goes down. So the only move that breaks, the move that starts this is this move here, right? And so that becomes the top of the range. Now this is a huge range, right? This is just, sometimes it's just like that. You just get these big ranges that you trade, and you could be in this range for, a long time. But so I then move it to the 15-minute, right? And so scaling into the 15-minute, the way I always do it is I say, okay, well, where's my traded range, right? And what was the point that started that range? Well, obviously this was that move down, right? Which we got an impulsive or a push back up to the upside. But of course, when we come up to the upside, we come down to here, right? And so the way I like to do it is, picking your starting point on your swing range. That's the point to the upside. Just let me do that again. Now it's going to be red because it's still negative, it's still down, right? And then there's the low. We don't pierce back up, but what we do is get a breaker structure here, right? Or a 15-minute down. So that's the first. You can see move down, come up, move down, and then obviously you're looking for that break. We break down. What was the move that created that downward move? Well, I would say it's actually there that breaks it. So I'd say here, because then we pushed up to come down, right? So it's this is the point, the first point that starts the move. What a lot of people will do is they'll take the point between here and wherever you finish or whatever that break occurs, and they'll do the highest point. The problem is, like I said in the rules before that I stated, when you do it like that, you miss a lot of opportunities, you miss a lot of good trading opportunities because your range becomes too wide, and oftentimes the retracement will be wrong because what you're anticipating is a 50% or a 70% or whatever the retracement is to some sort of supply zone or demand zone doesn't even come close, because your range, you're going for the highest point, where what I've noticed from my back testing is you go from the point that creates that low, and for me that would be that point there. So again, what we're doing is just mapping that out. That's the point there that created that low. So again, all we do is we draw a line. Doesn't matter where it goes at the moment, we just know that that's our high range, right? Now this move, obviously that breaks, continues down, and we could in real time when this is playing out live say, okay, well, got a few breaker structures here, 4 hour downs, 15-minute down, so that would be 15-minute there, and we get another break there. These are all valid 15 minutes. So you remember, each time when we come down here, you're looking for that 50% pullback, aren't you, or 70% pullback before you get into make a trade. And so it's like, okay, even on a small range like this, and of course it's all fractal, so you can, bring this to the 5 minute or the 2 minute or the 3 minute or the 1 minute. So what was the point? What was the move that created this break? It was here, right? So what we do, we just put that on there. Okay, this becomes now. See, the reason this was floating before is because it's net. If we get a break, this is no longer the valid high. It's that one. It's the one that creates the break, right? Each time. That's the key point. Let's just bring this back in. So I'll just delete it because it might take me a while. It's always best with rules. When there's a rule, you have a fundamental plan to follow, right? Now there's a few things that happen before this happens, right? So I'm just planning it in at the moment. We get another break there. It's just one candle though, so I'm not going to put that one in. Okay, but this is a true low, and this is our 15-minute range, right? So we've been bearish, creating lower highs and lower lows all the way down until such time that we create a break here, right? And then we get a 15-minute up candle. This was the move for me, the way I signify it, right? So if this was a continuous move without any liquidity, I would have took the point from here. But where did we take liquidity? So this candle moved up, and this was the next candle. It was an inside candle, but this candle took the liquidity of this one. You could argue, well, what should it have came down here? Possibly. Some people say you need 3 candles in a row. Some people say whatever. That's an arbitrary and subjective decision. But I can take both. But if I see a pullback that's taken liquidity from a previous candle, then I'm happy that that would be where I would take it from. So I would say this was the move that created that high, not this. So that becomes my new range. Bring it through there, and then that would be my dot here. It would be green. And then we'd have it up there. And then it's like, okay, there's my new range, right? But of course, nothing happens within this range until such time that it breaks. So we don't get any more structure breaks until this point, and we get a 15-minute down. And this is very reminiscent of that 4-hour scenario that we saw previously. So then it's like, okay, well, what was the high that created this move? Well, I would say, for me personally, it was here, right? So you can really see now we're getting very contracted with the range. The range has become really, really tight. And so the move that created that was this break here, which would be red. The reason I wanted to do it like this is I wanted it to be complex. I wanted to show it of exactly how price action is, and not just cherry pick some information that's like, yeah, whatever. So just to continue this move, so swing point here, that was the high. We broke to this low. What was the low that created that move? It was here. Okay, so where does the point go to? It's there, and that would be the swing low on a 15-minute there. So I might put 2 dots on there. Okay, that was red because so that broke that to the downside. So now that would be a 15-minute up created by this here. That was the move that started it, right? So that would be a green. I know this can be tedious, to be fair, but realistically, what you don't need to go back as far as this. The only reason I'm doing this to this point and to this distance is just to keep reiterating, going over it and going over it. But now we get some good breaks to the upside, right? And these are all traded opportunities. Now, right now, I've not even looked at where would I enter the trade. You know, where would be the pullback? Because you got to remember, a lot of this is going to be live. Yes, you're going to see these 15 minutes forming each time. So what was the move that created that? The question you always have to ask yourself is, what was the move that created the break? When you figure that out, that's where your point goes, right? So that is now there. And then that is my range low. Okay, just for now. But then, of course, we get another break to the upside, right? So there, another 15-minute break. What was the low that created that? Well, actually, it was that. You could argue it's that or that. So that was a push up. So it would be the low. It would be that one, because what I'm looking at here is this candle moved higher than this one. So theoretically, that could be a break there, right? And then you'd say, actually, that's how it would be. So that would be the break there. Technically speaking, that would be the breaker structure. Okay, and then you would have this one here, where you'd get another breaker structure each time on a 15-minute. Whether you want to put that in or not, it's just that we know, because we've got the price in front of us, that price continues to move up, right? So you get a series of pushes to the upside. What created that move to the upside? It was here. So effectively, like we said before, that is the move there, right? And then that is a 15-minute down, because we know that goes there. Then we get another break here to the high. I shouldn't have done this one first, by the way, because obviously that's been superseded, because here we have a 15-minute up. And then the move that created that was here, as we know. So I'm just going to put my dot here. That's the dot. That was the dot. That was the dot. So these are the so it's that one, that one. These continue to move to the upside. Then it was that one there. Then we range, and then we come here. Now I'd say, okay, well, what was the move that created that? Well, that was the up candle that created that. Let me just delete that actually. That was the one there. So that's the 15-minute down. What created that? Well, it was here. That's already got a point. But the move from there to there, so we have to put a dot there as well. Or swing point. From here. Then we get that move to the downside, creating that 15 minutes. So you can see, you know, that was a nice bullish trend, right? Going from higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. And then of course, we get that break to the downside, because trends don't go on, you know, forever, right? So we pull back. No push of liquidity really, apart from this one. You'd argue, but it's such a small point. But then we get that next one there, which is a nice move down. 15-minute down. What was the move that started that? Well, I would argue that it was probably this candle here, right? Price started down, come up, finished here. So I would say this is the point that created that. From there, that needs to be red. So that was our first move down. Sorry, so let me shift that out of the way. That would be red. That would be red. Like that. And then what happens then is our new range is here. Okay, and that was the low, but then we break through that, so the range low is now there, and that is our traded range. Of course, we trade that for a bit, but then we get this momentary spike to the upside, so that's a 15-minute up. Okay, created by that as the low. Put the dot there, and then, well, that move continues up to here, right? So that's where we put our dot there. There you go. So let's see how this is starting to paint a bit of a format on a picture now. Still got a fair old way to go, but let's just continue for a small while. I think it's important to really get to grips with figuring out these differences between the trended ranges and understanding how these things, you know, can still come through and peak out. So like, this is a classic example of what we'd call a liquidity grab, right? So comes up, takes liquidity, but now it's okay. Well, I would expect for this low to go. Then if this is just a liquidity grab, why doesn't the low go? But in fact, what it does is comes back up for another attempt again a bit later down the line, and then comes back down. Still doesn't take the liquidity, or maybe it does, I don't know. We'll see. So what do we got? So from the low to the high, let's just extend this out all the way to there. Okay, so then this is our trended range now, and we stay in this range. until here, right? So that is one long range that creates a 15-minute down, right? So what was the move that created that? Well, let's say it was here. See, so just a kind of sense check where you can go from all this really tight kind of constructive in and out, break to the upside, break to the downside, to this kind of consolidated phase between here and here. So that would have been your range, but of course it didn't break to the upside, just held, right? Because what you anticipate, strong high, right? Strong high, we've moved to the upside, so we anticipate that's not going to break. Of course, it's not infallible, it doesn't happen every single time, but we should always anticipate it. And so it broke, it sort of held, and then it broke to the downside. So that's that 15-minute move to the downside. So the question is here, right, is okay, so for every reason you'd expect, this is a liquidity grab, right? Big push down, breaks down, takes the liquidity, ends up being a slightly bullish candle. And so now it's like, okay, if it was a liquidity grab, why aren't we off to the races? What the market likes to do is create maximum pain, right? So take the liquidity down here, push to the upside, take the liquidity up here, and then of course it eventually starts smashing through and creates this other market structure here, which we'll see. So got that 15-minute low. So what created that was effectively this move here. So we go lower low to a higher high, down to a lower low, which is here. Call that green, red. Thing that created that was here. Okay, so now we have a new range. It doesn't last too long before we get a move to the upside. There's a saying, you should never trade in a consolidated market, and this is exactly why. I mean, you can see if we were, it's like each time frame becomes all that much stronger. You've just seen what happened when we looked at the macro landscape, right? Trend after trend after trend, up, pull back, up, pull back, up, pull back, until we got that break to the downside. When we're in a accumulation zone or a consolidation zone like this big range here, we should not be trading. Really, we shouldn't be trading this range, right? I'm just illustrating market structure even at the most difficult level, right, where it's really constricted and it's not really clear. But don't try to trade these ranges, right? You want to start to see volume coming into the market. You want to see lots of vector candles and stuff like that, which we get to in a short while. There's a kind of a difference when you start to see nice ranging candles and, you know, bullish moves. That's when we can start to trade the 15-minute ranges. But when we're in these consolidated phases, it's really difficult to get anything crystal clear and cast iron with these things. So anyway, so that's the low, which of course we moved up here. Of course, what created that? I'd probably say it was this move here. And so the way I would do it is, this was the move that created that push up. You could argue it could also be here. If I'm honest, I'm just getting a bit lazy. I probably would say it was there, to be fair. That was the move that started that, which ended there. And that's that traded range, which is here. Of course, we break to the downside. So after flip-flopping for a bit and going, you know, making a bullish move, we flip bearish for a couple of beats and we flip back bullish, stay in this traded range, and then it should actually be green because it was a high. And then we flip bearish again for one candle, and then we flip back up again. So that would be green again. Just there, if I can just shift that out of the way. Okay, that's the height. There you go. Then we start breaking down again. So that becomes 15-minute break low. Of course, what breaks that is here. That nice move down, right? Easy to see. Now, obviously the high holds, yeah, because enough times you think about this is what we call a classic supply zone. Liquidity's been taken, well, hasn't actually been taken from this side, but again, we'll cover liquidity when we get to that. But you can see here as a strong high, you know, we are making lower lows and lower highs, which is what you want to see when you want to start trading these ranges. You can clearly see it's a much better time to be trading, right? So there's another 15-minute low. Okay, then of course we break down again. 50-minute low. I'll backfill the dots in a second. Just want to make the point of where we are. I'll probably just go there for another 15-minute low. But this would have been a nice range to trade. 15-minute low. What each one of these sessions will do is build on each concept. What I'm mindful of doing right now is trying to floodgate with, here's where I've traded, here's the point at which you get in. I just want to purely focus on the advanced concepts of market structure, just so there's, you know, no each time we'll build on the previous one. So we started quite basic, and now we're bringing what we've taught ourselves on the first session into a much more difficult and real world environment. And so this is just how we need to do it, right? So this line that we drew here would have been the market structure, but now where we see, okay, on the range, that would have been a break, that would have been a break higher, so that doesn't no longer count. So move down, what was the move that created that move? It was here. So that was the first one, remember. Second one broke there, but that would have changed the move to the upside. So you would have got a small little break there to the upside, and then what happened then? Breaks back down again. What was the move that created that high? It was there, wasn't it? So that was that move. But you can just see how markets just play that, just look that range, yeah, to where it just breaks that low, or breaks the high on the 15-minute. So what was the high that created? So that was the low. The low that created this high was here. So that would be there. That just held. So let's just put our dots in. Again, on the 15-minute, it's not easiest to trend when you're just trading pure market. But you've got to remember, this is exactly what the consolidated phase is to do, right? It's just generate as much liquidity and trap as many traders as possible before a move to the upside. And I think when you map out structure like this, you get to see why it's so, why trading on shorter time frames is much more difficult than trading on swing. It's just not as sexy, right? Because you've got to be in and out. But you can see why, if you apply even good thesis and good market structure, you're still going to see a lot of these kind of moves. So you've always got to anticipate that effectively you've got to give yourself a little bit of wiggle room whenever you're putting your trades together. So anyway, so that break broke there, so that's the point. Down, then what do we do? Create a needs to be red. That's the high. Then we create the low. Then we come up here, which is then green, to round it off. Back down to the low, which is red. These are more truer liquidity sweeps, yeah, than market structure changes, but we've got to play to our rules, right? Then what happens, we come up here, fall into a high, and then a low. That holds, come back down, and then we eventually move. But actually the move that creates that is the range there. We get the range, which is there, and that is the low. So that is the candle that creates that low. This is fine. So that becomes our range. So we get a green point here. Which would be there. And a red point here. Oh. Okay. So once we get that range, things start to change a little bit up a bit now, right? And this is where we start to see a much better traded range, right, where we can trade it properly. So we come out of the consolidation phase, we come into here, which is a 15-minute up as we break. That then creates this range here, and that there. So within this range, what do we always anticipate? That, you know, we come back and retrace. Now clearly that's the high, this is the strong low, which you don't expect to break. Of course it does break, just because it's shorter time frames, and you're always going to get breaks on shorter time frames. But so that breaks. What created that low? Well, it was this high here. Okay, so that becomes the move there. And so the range then is here, there to here, but that becomes red because then we get a move down, and then we call that a move down there, and then we get a series of taps to this downside, right? So from a range perspective, that's there. What was the move that created that? It was that, so that hasn't changed. Then we get another break there, and we just make that a 15-minute down. So 15-minute down. What was the move that created that? Well, it's just this candle here, right? So this is the move down. So because it's all market structure, that's lower low, lower high, final lower low, and actually that's also the high there. Then we get a break to the upside, and then we flip bullish. That becomes 15-minute up. That becomes our traded range. Okay, so again, this is just one impulsive move from here, and so the range then becomes there. And the reason I know this is one traded range that we don't break is because that's the low and that's the high, and so all of that contraction that we've seen, we're starting to see movements now, right? And so, you know, what are you looking for when you come in? Like I always say, when you get momentum moves, it doesn't always have to do that 50%. And I'm slightly going off movement here, but if I just change that to the reversal range, not quite 0.5, but you know, at the 30%, probably about 45% retracement, right? And then it was off to the races again. Okay, so that was the high there, which broke. Sorry, that should be, you just move it out of the way, it should be green, like that. Bring it back down. That should be a 15-minute up. Okay, so that was actually the move that created that. So that's just that swing range. Then when we get the break, here's where things get a bit more funky. What was the so this is the point. So we broke that move there, right? So this is a 15-minute up. So the move that started that, as easy as it needs to be, that one, isn't it, really? That's the candle that created that move up. And so where does this finish? Well, here. So when we were drawing our range, what we're doing is we're saying, well, that's the green, that's the high. The reason that's the high is because then we get another break of structure of 15-minute up, like that. And that's the range. Then it's like, okay, what was the move that created this break? It was here. And now we know this is the point where we flip bearish, right? So the first, from that move to the upside, it's the first indication from a series of up moves. The moment we get a down move, it's like, okay, well, now I might need to think about being bearish, right? And so what's your new range? Well, this was the move, this was the candle that created that move, or this was the, well, actually, I would say it was here, right? Because we came down, we got the liquidity from this candle here, and so this becomes the high, not there. And so what I would do was I would have that range, right? So that would be red. Of course, that was the low. So now my ranges flip, right? So again, this is the strong. So now, because remember, if it's up or down, and if the last break was either up or down, well, if it's down, the top, the height becomes strong because now we're bearish. Now, even if that flips back bullish again, you've got to stay with that mentality, because when we look at the risks to reward ratios in a subsequent session, you'll see that it's okay to take some losses. It's mechanical, it's methodical. Understand that, you know, once we come out of this consolidation, like, you don't know you're going to be in a consolidated phase. Well, you kind of do. Whenever you get a big impulsive move, you know we're going to be in some sort of consolidated range. You've got to think about that a little bit and how long that's going to last. Well, you can normally look at things like Bollinger Bands and any kind of indicator that shows the contraction, volume, all of these things. The lower and lower and lower volume gets, looking at shapes and patterns purely for inducement purposes, you can start to see volatility. Anything to do with volatility, when volatility starts to get too low, eventually it will always crash out, okay? Let's continue anyway. So again, this was a perfect move, right? So, you know, that was 70% to the absolute dollar accuracy there, right? So if you're waiting for a move, just bring that down. You know, look at that. So move comes down, that's the low that was the point that created that low. Now think about it like this, right? I'm not saying this is done by anything other than my system, but if that would have been the high, well, you're not quite 70% range there, are you? Just above 50. But by being here, it gives you more, I guess, more opportunities in the trade. And so that's why I tend to favor that, rather than, you know, you could say, well, isn't it just the high between the 2 points? So between this point here and this point, don't you want to go to the highest point? Some people can. I just like to go for the candle that creates that move. Again, it's just purely based upon back testing, but each to their own. But if you're following me, that's how I'm creating my ranges, right? Okay, so what was the move that created this break? It was here. So we can bring that down. We get another 15-minute down, and you can just see the ranges are getting wider, and so now you can say, well, okay, bit of a liquidity claim there, so that becomes our new 15-minute down. And again, all we're focusing on is market structure, nothing else. That's all our focus has been on, nothing to do with trading or execution or anything. But having this down and understanding this when we come into the other sessions is going to make you think, okay, I understand now why it's so powerful. Even though it's quite tedious, even by my standards. Okay, so what's next? So what was the high that what was the candle? Well, I'd say it was there, right? And so now after kind of some moves down, we're consolidating again, right? And it gets a bit boring. So now it's like, okay, here's your 15-minute high. And so where's the low? Well, what I've not done, by the way, is creating me dots. Sorry, I just need to backfill them, so we're good. So now it's red. What did we say? It was the point, it was there, right? I created that. Where did we go down to? Went down to there, and down to there. So our traded range is here. Okay, I'm just going to put it there for now. We get a break. What created that move to the upside? It was here. That was the candle that started the move. Okay, so we can call this one red, then this one green. So that's the first sign of a move to the upside. It's like, okay, now we need a new line there. And this is our traded range, right? So we stay in this range. We need a break up or down. We just claim liquidity. And then we get another move to the upside. But again, you know, look, perfectly beautiful supply zone. Now if you're down here, and this was your lowest point, you know, you're not going to get that move, are you? Because you would have been waiting for the trade. And then you would have got a wick here. So in this instance, the candle that created that high became the perfect foil for a dip into the supply zone. Again, we'll cover this, the demand zone for that move to the up, and where you're always going to target the weak high, right? So this is the weak high 15-minute break. Then it's okay, what created that move to the upside? It's probably going to be here. Then we get a low. We go into this horrible consolidation-y phase, which isn't great. Created that dip down. Well, actually, before that happens, we get another break to the upside. Sorry, so I just need to get this right. Another 15-minute up. Then that was the point that made it. So we're just going to mark that. Like that. That was the low. That was the high. So it's a bit messy because it's getting a bit tight, but it's the traded range now, so it's there. And then that would have been the low, but we break. And so as messy as it is, we've got to stick with our system, right? And get a quick flush out and then a flush back down, 15-minute low. What created that? This was the low. And then look at this, we range for, wow. We just range in this for about 4 days. And this is it, we're caught in this range, right? So then we get a huge 15-minute move to the upside and things are popping. So it's like, okay, what created that move up? Well, I would argue it's the candle is here. So that's the move that brought it up. So there. Okay, so we get a break. And what happens? So let's just do our dots. So this was the low. So that would have been red there. That was a break to the downside. And then we get this green move here. That was created by this. Need to zoom in a second. There. Change that to green because it breaks. Then So what we've got, we've got swing points and we've got market structure both on the page, right? Swing points are the highlighted blobs, and then the breaks of structure. The market structure is this these lines here, right? So let's continue. Let's just automatically lay this out a little bit. So that becomes our high. So then it's like, okay, well, what creates that move to the upside? So we got that break there, right? That needs to be green. Get that break. $15-minute up. What's the move that creates it? I'd argue it's probably that. So we get nothing but a bit of a trade range here. Let's see. There's our traded range. When we make that move up, of course, price comes in, we get that break. That's the first break of structure there. 15-minute down. Okay. There's the move there. So from that huge range to this tiny range, right? So see, that becomes a 15-minute break. That's the high that creates that low. Then we get another low here with another break, which is valid. Let's see what happens first. So we stay in this range here, right? So that we need to make that red. So we've maintained bearish. So gone bullish. We flip bearish from there. That would be the first bearish move. Then this was the move that created that actually there. So trust me when I say, when you're doing this live and you're watching 15-minute candles, it becomes an awful lot easier than back testing it. It's just way more intuitive, right? So let's see. That's the high, that's the move that created this low, and we come back in, then we break down again. That's the move that created the low, so that becomes the new high structure. Okay, let me just zoom out a little bit, and then I'll just draw this line here to find my feet. So what happens first? This happens first, right? So we get a 15-minute up break, and it's like, okay, well, what created that break? Well, it's probably here. There, so we got a nice 15-minute break up, followed by a 15-minute break down. So we get that there, which is a green. Come down there to red. Then that becomes our range there. And here, right, and then we get a break, so 15-minute breakdown, and now we are bearish. That is not required. What is the move that created that? Well, it's there, but that is one move without taking liquidity back, right? So this is just a series of breaks, 15 minutes, right? So 15-minute down. We'll backfill the highlighter tool in just a second. 15-minute down. Wow, another one again. 15-minute down. So this is just a lovely traded range. Trust me when I say this system would have got you a nice fair old few moves on this one. That would be 50 minutes down, just continuation of the trend, right? Bearish trend. So what happens? I've been consolidating for some time, and then we come into a nice traded range. So let's just go over what we did, right? So this would have been the high, right? Because it was this candle's move that broke this previous low, and so that would have been the high there. So from a structure perspective, doing dot to dot, then what created this low, this move here, okay, to the low, and then what created this low, I would argue it's here to there. And so each time, right, the high would have been here, there. So from this move down, right, this would have been the only one where you would have had a struggle, right? So if you look, we're looking for the 30% range. At minimum is 30% range at its weakest, but you didn't even come close. I need to invert that just so it makes more sense. I think if I come down from there, yeah. So you can see, you know, it come up to here. It's like 25% retracement, not very great. But it's what happens sometimes on these momentum moves. You don't get an opportunity. So that one would have been a missed opportunity. Didn't retrace back high enough. But then from here to here, you can see from the high to the low, retrace back more than 70%. That would have been lovely. And then from here to here, let's see, from this red here to this red, there's 70%. If you look along here, tap that 70% lovely twice before breaking down again. And then finally, the move. So let me just draw the rest of these dots. So what creates this break? So let's see, it isn't, it's perfect. That becomes the line. So, you know, if I look at the, so this is the break, right? That's the high that creates that break. Just do the dots. I'll go back to the 70% thing in a second. That's the move that creates that. There, so we've got a range. So where's the retracement between there and there? Again, you at least favorably for decent movements, you want to see 70%. You can see tag that 70%, absolutely perfect. Let's do it again. From here to here. Now price kind of consolidates, so we know that wouldn't have been a successful trade because it ends up breaking. So where's the traded range? And that comes down to there now. Break, we break. This comes down to there. Let's just make this a lot easier to see. Look at that, wow. Okay, so now gotta break to the other side. So after that huge move down, now we start breaking up. What was the move that created that high? That is fake. That is not a that was because I'm using a cap. That is not a true. It's because they have a gap hour. I think about 10 p.m. or 11 p.m. or something like that, where they catch up to wherever the current index price is. So that is not a true break. And so really, this is that one move that created that. So I would leave my why would not a 4-hour high needs to be a 15-minute high? I would leave that dotted line. So you can see the difference, by the way. The dotted lines are more close to see. The thick lines or the solid lines are the 4-hour. So let me just go back into auto, because how much more have we got to go? Not too much more, right? We're not far off now. But you can see as kind of, as painful as this is, I really wanted to spend a lot of time on this one because I think it's it's the bit that if you keep on going over it and listening to me, even me kind of second guessing myself sometimes, not to say that I'm the greatest trader in the world, but I've spent enough time with market structure to kind of be able to sense check and understand where I am. That, you know, it takes time, it takes practice, but you'll get there, right? So this is the break, that 15 minute. So again, this was the, no, I'm not. I'm going to say that that was the move that created it, right? Because we did retrace back from there, right? Price comes up and then we retrace back. We take the liquidity each time down there. So I'm going to say that this is the move that created that. So we can map that out, right? That's the 15-minute high. So we can't create structure until we break that. But I'm going to say that that was the low that created that high. So I can mark that one. And I can mark that one as a green high. Okay. And now we just continue on. So the next one is here. Gets broken again. What was the, oh, it's nice and easy, that one, isn't it? That was there. And again, the significance of all this won't come into play until we look at supply and demand, right? And how it all fits together. So if you're stuck this far and you're kind of sticking with it, well done, because I know it's it takes a lot of time, but this becomes quite easy. You can see we're kind of just flying through this now. 15 minute. Hopefully you start to see this yourself. So what was the high that created that low? Well, that was really just one move. You could argue you could have there. I'm going to leave that one as is, I think. But remember, right, this is, if you remember when we were looking at that trend change, you know, look, higher high, higher low, higher high, higher low, higher high, and then something strange happened, right? This doesn't create that new high. In fact, what it does do is create that low, right? Now, if you remember, what we're looking for is that first clue of that first trend break, right? Because then we can flip bearish and be confident that that's potentially where we are headed, right? And so that's our first, after a series of hits to the upside, our first 15 minute down. Now, what was the point that created that? I would argue it's here, right? The top of there. Okay. And then we just get an absolute lovely set of trades to the downside. So I'm just going to rattle through these quite quickly. 15 minutes. Don't second guess yourself if you're doing this, right? But just have conviction when you're going through these and saying, right, oh, is that this, is that that? Just always remember a couple of things, right? Say to yourself, what is the move? So what is the high that creates, what is the move that creates it? Like, that's the high. Between that point and that point, that's the high. But it's not the move that started, right? Because it came back up to take the liquidity from these candles moving down, or at least some of the candles moving down. So the move that created the break was here. So for me, I'm really only interested in that as that point, not the high. Same with each one. So if we just backfill some of the dots for swing points, well, that was the move there. That was the move. That was the move that created the low for this high. And this low, right? That's not a swing point because that didn't create the low, but this did here. Okay. Then we flip bearish. So again, just dot that there. It's not perfect, at least. There. Change that color, and then that's the move. That's the move. That's the move. There you go. That's the move. That's the move. So we get a series of nice moves to the downside. I'm just going to remove this a second to see where I am. So where's my last traded range? It was here, and it was here, what breaks first? This, so this becomes a 15-minute high. What created that high was here, therefore we dotted there, nice and easy. So then that becomes my new range. That doesn't last long, it gets broken. You get really messy again here, right? 15-minute down, but then we also get a 15-minute up. So there's no bias here, by the way. This is just true market structure. This is just laying out exactly how markets work and how market structure operates. I'm not having a bias towards anything here. Just showing that, you know, we trend up for a bit, then we trend down for a bit, stuff like that. Where we really see a lot of this come into play is when we do that multi-time frame analysis, when we mix the 4-hour and the 15-minute, and kind of not focus too much on these kind of consolidated moves, but how we start to really apply ourselves a little bit, right? So what happens, that becomes our new range here, the 15-minute down. What creates that move? No, I would say it was here. I'm just doing a market structure and I'm going to fly back and do the moves. So 15-minute up after that move down. Actually, that's not strictly true. I'll leave it there, but I think I just need to do this move first. That was the down move. 15 minutes. If this was happening in real time, you would definitely apply that. What was the move that created that? I would say it was the vector candles. I know we got a bit of a move up there, but it's not clean. That feels clean there. So that was the move. We go high. The point that created that is here. So that was the range high, and then that was the range low. So now after being really contracted for some time, now we start to really spread out a bit, right? So let's just backfill where we're at. So that was the low. There. Ooh. That becomes green. Ooh. My bad. Becomes green. Like that. So we get a low and a high, which we'd call a lower low and a lower high. So it's a flip change, right? So 15 minutes. What's the what creates that? That for me feels like one move, right? So it'd be there. Look how well that strong low holds, right? Perfect strong low. Tapped the just into the supply zone as good as you're going to see it. That okay, lovely. That would have been a perfect move for an up move. Break to the upside. What creates it is here. We can't denote that to structure until we break, but then it breaks, so it becomes a lower high. We get a nice green dot. Technically speaking, I'm not going to, but each one of them is a breaker structure to the upside, right? But I'm just gonna, because I'm being a bit lazy, I'm just gonna say that was the high, right? But you have got a little bit of a small range there. So then that's the range. Roughly there. Then what happens? Get a small break. What is the low that created that? It's not clear. But I would say probably comes down. That's the highest point that it starts to come down. Maybe here or here. This is one that's open to interpretation. It's not clear what creates that breakdown, because you could probably say it's here. Just have a little small just firstly change this into a low. large 15-minute low after a 15-minute high. What created that? I'm just going to go with that. Yeah, that move there. And what do we get? A 15-minute high. Okay, and a low. What creates that high? It's here. So we get a low there. I think what creates that high is there. A bit messy, but stay true to the rules. Okay, that's a low. Oh. 15-minute low, and then we get a series of breakdowns here. So nice trades all around. So what creates that low? It's there, isn't it? So my eye naturally draws to the kind of retracement of that 50% or 75% or 30 to 70%. And of course you've got a nice supply zone there, which is perfect. So that would have been a really nice trade to start thinking about targeting. Let's just zoom out a little bit to see where we are relative to our 4 hour, right? So now, obviously there's our 4 hour range, right? All we've really done with all of this is just traded within that 4 hour range. We are coming to the end of where we are, but remember, this is what we want to talk about into the more kind of higher time frame stuff and the multi-time frame analysis. But as we're approaching a strong high, we expect price to start breaking down, because eventually, it's all about getting liquidity higher and higher into these regions. And so for me, this is live price action now as we see it. I'm anticipating higher highs and higher lows up to a point of supply and demand. And again, we'll cover that before a breakdown of a move. So whether you determine that needs to be a swing, or whether you're just going to day trade it and just keep on riding the trend down, or does it surprise us and break the strong high, and then we have a new traded range on the 4 hour. What I'm trying to say is on the 4 hour, you can see it's a bit more clean. It's not as kind of flip-floppy as what you see on the 15-minute. And then the daily range, again, is even cleaner again, right? And so what I'm saying to you is, when we think about the market structure, like how clean is that? Higher high, higher low, higher high. Then we get that break to the daily low. Lower low, lower high, lower low, lower low, lower high here. And then we start flipping bullish again. But it's a lot cleaner. Much cleaner than the 15-minute and the 4 hour. And so the higher time frame you trade, the more reliable the market structure levels are. It's just as simple as that. So try not to get yourself too locked into the lower time frames, or if you are, try not to hold them for too long. Just understand that when it's live, when you're seeing these trades play out, that it can flip bearish, it can flip bullish, whether you're using the strong or the lot or the weak as target points. Don't try not to hold onto the trade for too long, right? That's what I would say. If you trade on the 4 hour and it's a swing trade, absolutely go with it. Okay, so just to get back to it, so that was our 15-minute. So that was the high. Didn't break range. This was our previous range right there, which would have been there. So we stay within that range until we got that break. So there's our first breakdown there. So quickly polish that up. That's the low break, so we change that to red. And there's the high, so that would have been green. Just tighten this up so we can get it finalized. Then what happens, we break down low here, so then we that was the trade. Just remember, swing points don't always have to be the structure breaks, right? So that was still bullish, and then we got that trend change to the downside, right? So here now we go red. There goes red. I'm jumping the gun a little bit here, but just because I can see what's coming next. Okay, so 15-minute down. Where was the move? I would say personally, the move was here. And come down, got a bit of liquidity, push down again. This was the move that created that high, so I'm just going to create that 15-minute high there. But before that, the continuation of that move is down, so actually that might not be the 15-minute. We just need to double check. There's another bearish move. 15-minute, a series of breaks down here before eventually getting to this point. This 15-minute break. Okay, what was the high that created that low? So that's why that doesn't count. It's here. Now the reason, like, think of it like this, right? The reason this is powerful is, like, if I said, actually, well, that's the high, right, that created that low. Like, and it doesn't always work like this, but, like, that's, so for me, before I know that that's a 15-minute break, this is a strong high, right? Because we're bearish. So I'm always going to think that this is a strong high and we're expecting that this is always going to break. But because I'm looking at the break, so the break was created by this, right? So my high becomes the one that breaks it. Now, luckily enough, the break occurs here. And so when this break occurs to the upside, we get this small retracement, right, between here and here, which allows us then theoretically to get into a long trade, because now we're expecting the lows to be strong and the highs to be weak. That would have allowed us to potentially catch these big, huge trades, but it wouldn't if you're just waiting for the high point between here and here. So that's just another reason. It doesn't always work like that, but it's just another reason why I always prefer to use the move that creates the break rather than the high point between the previous two swing points. Okay, so that's the break there. Then we get another small break at the top of this wick, as small as it is. Okay, so just quickly tidy up. So we get a move there, which is bearish. Then we come to here, another bearish move, and then we get that break there, which is our first green, signifying a move up. Then where's the move that creates this high? Well, it's down here, isn't it? So the trade range from us at this moment in time is somewhere like that, and then we come up to here. You could argue that this is the high, then we make a low, then we make a high, but for what it's worth, because we can see the candles in front of us, it's no point doing another point there. So that's a 15-minute break. Where's the high that creates? There's the candles that make that move. Well, I would say it's here, because we come up, then we come back down before we come up again. So that's the move, not here, according to my rules. Okay, so there's the high, and we get a break. Get 3 hits to the upside. 1, 2, 3. So that's 3 15-minute ups. 15-minute up. Okay, so what's the lows? Gets a bit choppy, but you probably say it's there. And you could keep to that. But if you're following the rules, it's that, and we do get a little break to the downside for a little bit of choppiness. So we get a break there, 15-minute down. Then we get another 15-minute down there. So 3 hits to the up, 2 hits to the down. That becomes our traded range there. What's the move? There's the move there, right? That's the move that creates that low. Okay, perfect. We get a 15-minute high. See, if I'll just try and apply this at my typical speed now, right? Because you've seen what I'm doing. It's just repetitive, right? All I'm just doing is continuing what this is. So I'll try and just go at my pace of what I would do it at, right? And I'll backfill the dots in a short while. So let's do that. See that this was a lovely trended range where it just continued to trend and range higher. I'm going to skip these 3 out and go straight to there. But that was nice. Lots of nice moves to the upside. Okay. Before, that was the move that created the last high. This wick doesn't count, absolutely doesn't count, and I'll tell you why, because that is a scam. That is just where the exchange, it was the same as what we saw before. It's moving up, but then it stops and pauses for 45 minutes or whatever, and wherever it brings it back in, it'll just put a line. So that's not a true candle formation. 15 minutes there, again, that's our traded range. What creates that break? Well, it's here. So there's our new range. Perfect. And now is where it really starts to look nice, right? So you've got another range there. Nice, beautiful retracement down to that 70%. I can just see between here and here that retracement's about 70%. So that, again, you've got supply zones in and around here, or demand zones rather. Lovely move. What happens? Same again. Boom. Right into that zone. 15 minutes. What creates that move up? It's here. There. Where's the range between here and here? Probably about 70%. Lovely again. Another stunner move. And then what happens again? We get another break to the upside. There. Again with a nice 70% retracement between here and here. So this is where it's really nice, right? And you can clearly see now we are getting closer to that 4-hour top range. And so from this point here, that's just been one beautifully traded range of just, you know, in and around that 70% pullbacks, 50% pullbacks into supply zones or demand zones rather, ready for buyers to buy in again. We had that little kind of move to the downside here, but you know, if you compare this zone here, even though to be fair, you still got some nice moves to the upside. You know, whatever you see in these greens, it's higher highs and higher lows, and we see in the reds, it's lower lows and lower highs, right? So you're still seeing some level of movement. Just gets a bit whipsawdy, which isn't great. You get a bit of a kind of a mess here where you get a little bit of a spike down. So you've got to be mindful, but you can clearly see with good solid market structure, awareness and understanding how the market moves, you can absolutely take advantage of this. And where it really comes into play, and I keep repeating this because I know it's important, is like not just blindly constantly going, you know, strong high, strong low, weak high, weak low, whatever it is. You always got to pay attention to your opposite time frame. So I always trade in 2-hour slots, right? It's 2 time frame slots. 4 hour is my macro analysis. My 15-minute is me micro analysis, and my trade execution is 1 minute analysis. So when I'm approaching a zone, like none of this is limit order based. I'm watching the candles, waiting for it to come into a zone, and then I'm executing my trade, having a relatively tight stop loss because I'm confident in the zone holding. If it doesn't, no foul, I can move on to the next trade, right? Because eventually when you do get the moves, you know, some of these can be really nice, okay? And that's where we are right now. So, you know, you take this in, understand it, practice, keep on practicing your ranges. I suppose I better just fill in the moves, right? So just quickly, are we on auto? Get on auto there. So, you know, I can see where what I'm looking for is I know the dots. I'm looking for the moves that started, right? And they're mainly going to be green. So there's the move that started it. Come to here. There's the move. Come to here. There's the move. Come to here. We go with green to red. There's the move. There we go. And then we flip to green. There's the move. There we go. Move. There's the move. Go there. There's the move. So there's the current traded range. Okay. We break. And then we finish with here. Okay. And now we're finishing on our final live and up to date trended range, right? So that is our current traded range there, our 15-minute traded range. Now, because we are bullish right now and we want to go with the trend, this is our strong low, which we expect to hold, and this is our weak high, which we expect to break. Okay. So that's the advanced market structure. That is all really about applying what seems pretty straightforward on the basic analysis onto a chart with, you know, a bazillion different configurations of up, down, left, right, and that's just the nature of market structure. But just take away these key messages. When we are truly consolidating, right, which is usually after a big move on the 4 hour, when we are truly consolidating, it's probably not the best time to start trading on the 15-minute or the lower time frames, because the market structure may not be as forgiving, let's just say, than when we are trending nicely on a 4 hour, because then it's nice. It's like kind of this feeling, right, where you get nice moves up, small pullback, nice moves up, small pullback, so on and so forth. Second thing is always even that being said, always trade the trend, right? Always expect the strong to hold, and always expect the weak to break, the weak high or the weak low, whatever it would be relative to the time frame. Keep practicing this. Keep figuring out your time frames. Come ask me as many questions as you want. If you're unsure about a specific move or a structure or something that you want me to have a quick check on, you know where I am. I'm in the server. DM me if you don't want to ask it out loud. But next session we're going to be bringing in some additional content on top of this that really starts to bring all this together. So if you've got this far, you know, this is over an hour and 44 minutes, so quite a long session. But trust me, if you got through to this and you can start to pick this up, you're already a better trader, that's for sure. So that being said, we'll leave this one here and I'll see you guys in the next one.